Welcome back. The market has been trading flat with a bit of an outperformance from the mid-cap space. The couple of stocks that really stand out in trade today, in fact, are TCS and Asian Paints, both up 3%, and even metals have been doing well. Reliance also trading comfortably above 800. Let's talk about mid-cap one stock which has been doing quite well with big volumes, HEG. That stock is up 12% at this point in time. Manvinder Singh Ajmani now joins in, head corporate strategy at HEG. Mr. Ajmani, hi, afternoon. Let's discuss your numbers, because while the market is getting excited because of net profit, it looks like that's mainly because of on comparative quarter last year you had a forex loss, and actually on EBITDA front you have come out with 73 crores versus 77 crores and lower margins, about 16% versus 19%. Could you tell us the factors behind that, and going forward, what's the kind of margin trajectory that we can expect?
See, the EBITDA margins have been better this quarter, largely on account of volumes and some better realizations from on our export front. And that has led to a better performance. Overall, the EBITDA is about 307 crores, which in a challenging steel environment...
No, I'm talking about the quarter, Mr. Ajmani. I'm talking about the quarter. I'm talking about Q4.
Yeah.
Where you have done 73 crores.
Q4 EBITDA is... Correct. The Q4 EBITDA has been higher because of the fact that we have had good volume realization. They are marginally short of the by about 500 tons than the same quarter last year. So hence the marginal gap in the EBITDA.
Okay. Can you explain now, margins as well as the total EBITDA is lower for the fourth quarter compared to the year ago fourth quarter. What would be the reason for the lower EBITDA performance, you said?
There's been a slight gap in the volumes vis-a-vis Q4 quarters last year vis-a-vis Q4 quarters this financial year.
You mean you sold less?
There's a marginal gap. Sold less about, yeah.
Okay, but you expect that to get corrected in the coming quarter or in the current quarter?
See, this given the steel scenario worldwide, we do see some pressure on the volumes going forward. And EF, which is our principal customer sector, will of course also have its own share of pressures. While we expect that we will continue to be able to maintain above industry capacity utilization rates, this year we have done approximately 75%, and we hope to continue to do that. And please compare this with the graphite majors of this world, which are really presently operating at close to 65% or so.
Okay.
We are, as always, ahead of the industry, and we expect to continue to remain so.
Sure. Mr. Ajmani, finance costs, they have gone up. Because your EBITDA is 73 crores, still you end up making a profit of only 35 crores, and that too with the help of a bit of forex gain. Anything you're working on in terms of reducing this finance costs? Any timeline you have in mind?
Sure. We look at that the overall our finance cost is in a fairly reasonable territory. We have incurred some debt in the prior years, primarily to fund our expansion from 60,000 to 80,000 tons. Due to the market conditions, we have been unable to utilize significantly this additional capacity. Once the capacity volumes improve, we will be able to bring down the overall cost. Even in the present stage, our finance cost relative to our debt is in a fairly good territory. It's in sub 5 category, sub 5% ratio.
Okay, so give us some guidance for FY14. How much might you do in terms of total revenues? This time I think you stood at 1600 crores or thereabouts. How much might your revenues grow? Where might your margins stabilize?
We expect that the EBITDA margins will remain somewhere in the same territory, between 16 to 20%,
okay,
depending upon how the steel sector pans out, particularly in second half of the financial year. In terms of quantities, in terms of volumes, we expect that we'll do close to about 75% or thereabouts. However, we also expect that the prices of the graphite electrodes have shown some softening trend. They are likely to be largely offset by the price softness in our principal raw material, that is the needle coke. So overall that effect should get neutralized, and we should be able to stabilize and maybe even improve margins. We are taking steps on the operating improvements, which is a major focus area for us, and we hope to deliver better performance going forward.
All right, we'll leave it at that. Thank you very much for joining us, Mr. Ajmani, with your thoughts. That's HEG, benefited by a 2.6 crore FX gain compared to a loss last year, but otherwise they believe they're doing still better than other graphite majors. Take a break on that note. We'll come back and discuss